recorder's on. So the question was, thanks for having me, everybody. As you know, Scott's over at the TD Ameritrade offices today. Not all day. I think he's just there. He should be. I think he's doing his last part. I'm not positive about that. But until then, so the question was that we want to do a quick review about diagonal spreads. And and the important thing to remember when you hear the word diagonal, you should still be thinking the word calendar, because they are a calendar spread, meaning that you are buying, and usually in our case, and almost always in our case, 99% of the time, we are buying the back month or back week or longer dated option, and we're selling something in front of it. That's the calendar. So there's a time, you'll hear it called a time spread sometimes. We call them calendars. And in a straight calendar, it's the same strike. Next week's $100 call versus July $100 calls would be the 100 calendar spread. A diagonal spread is a calendar spread in that there's two different expirations, but the strikes are different. And you can do it either way. You can have and let's just stick to a call example. The put example would be exactly the same thing, but pardon me there. Anybody have something, a stock that they're looking at, just to have, use an example. You can use anything. Obviously, you can do a calendar spread in anything that has options. At least, well, anybody that has options with more than one expiration. All right, Pamela was first. Lulu it is. Thank you, Pamela. Okay. So now a calendar spread. We'll start with a calendar spread, and let's just say that we are going to, let's say that we're bullish, and for whatever reason, we want to do a calendar spread. And everybody knows that the reason for calendar spreads are usually twofold, or maybe threefold. One, there's a big disparity between the implied volatilities of the different expirations, which you'll see in the days, maybe even a few days before the earnings. Because why? Because people want to buy that gamma-rich option, that short-dated option, so they pay a premium for that. Here we're seeing something that I would imagine would be pretty flat, which it is. Next week, the vol in Lulu is 28.23, and then you see basically we're talking 27.5 kind of across the board. That's a usual time structure. Flat, and sometimes you'll even see the front month a little bit below. But you can see, if we get 60-day implied vol here, and let me get the historical out of here, you can see that as you go to earnings, shorter dated options have a higher implied volatility because of that gamma rich that we were talking about. We talked about Z, Stephen. It's a calendar spread, and we will be looking to roll into something on Monday. We'll let the Z go off worthless on today's expiration. Don't worry, we don't keep any secrets on that. But okay, so let's just say that we want to let's do something along the lines of next week, and let's look at doing something along the lines of a 185 call calendar. And we'll go out to regular July for the other one. So a 2-week spread. 185s we buy here, and we sell the 185s in front. And we know that the risk chart for something like this is going to look like that. We know that if we are below our strikes, and let's get rid of all this stuff. We'll look at it on today's date. That if we are below the strikes, at expiration of our back month, we're just going to give away whatever premium we paid. As we go up towards the strike, so ideally you want to go to your short option, which is, in this case is the 100 strike. You want to, because then the short dated option is going to be worthless, and we've maximized, at least for the time being, the value of the back month that we own. So you want to go right, ideally a grind right up to the strike in the case of a calendar spread. Okay, so now a diagonal is the same thing, except you are going to have, you can mess with the back month. So let's just keep it at 185 in the front, and we can buy the 182 half, 185 diagonal. So we have so this is going to be more delta rich. And you're like, well, Mike, why wouldn't we always do that? Why wouldn't we always do a diagonal? Buy a lower strike back month and sell something with a higher strike in front. Why would we not do that all the time? Because we can see that basically we lock in some premium. Well, or we just have a better P&L looking line. The reason is it's more expensive, right? The calendar itself, the 185 call calendar, is trading for right now about $1.73. If we do the diagonal, that's going to cost us more money. It's going to cost us $2.70. It's going to cost nearly $1 higher. Because why? Because we're getting that $2.50. Our logs are kicking in before our short. So again, the best place to go is to your short strike. Go to 185, because that'll make the next week's 185s worthless, and then these will be worth $2.50 at the very least. And there, of course, there'll be some premium still in that. So that would be the best case scenario, would be to go to 250, or to go to 185, because then all other things being equal, it makes about 75 cents on that, and that's if implied vol stays the same. Now you can do it on the other side too. You can do a diagonal where your long doesn't kick in until after your shorts. Well, now what's this guy look like? Where'd you go? Oh, it's down here. Because, sorry. All right. Come on. That's what it looks like. So now this is having this is the 180, we have the 187 halves as our long, and their shorts are still 185. Well, now you have yourself some risk, because if we go to 187 half, well, now we have a call that we're short in the 185s that are $2.50 of the money against us. But what do we get? What is the opposite side of that coin? Well, this thing only costs a little bit less than $1, as opposed to the $2.73 for the front-weighted diagonal, back-weighted diagonal, and about 75 cents cheaper than the straight 185 call calendar. But you run the risk of running above 185, because then you can see that you make money, make some nice money going up, and then at 185 you start to lose that money, and in fact you can actually lose everything. Plus you could lose $2.50 plus whatever you paid to get in. So you'll see diagonals. You'll see us do diagonals. I would say that when we do them, they usually are back weighted, meaning that on the call side, that the call is closer to the money, and that's just a function of just that specific instance, wherever implied volatility happened to be, where the underlying is, that sort of thing. There's no hard and fast rule of this is when you do a diagonal. It's usually you just have to take a look at things and say, hey, listen, this is a really cheap calendar. Maybe we can actually do a diagonal and pay a little bit of more money, but get ourselves a higher possibility of some decent return. Okay, what questions do you have on that? And I did record this, hopefully. It's only about a 10-minute video. Right now we're at about 9 minutes and 10 seconds, so we can review it easily. But if there are no questions, then I will just render this video and get it out to you guys ASAP. I'm trying to see if anybody's typing here. Should you look for one-to-one risk reward? I would say that you're going to get, if things work out, most likely you should get better than one-to-one risk reward. But remember, the risk reward, that's maximum reward to risk. And that's just a matter of style, just be consistent with what you're looking for. Okay, let me get this video out to you guys. Thanks for having me. I'm going to be bouncing back between the rooms as Scott continues his morning over at TD, and we'll be good.